something profound is happening in Latin America. A transformation so gradual that most people barely noticed it at first. What was once considered America's backyard is now quietly turning toward a new partner. At the start of the century, China's footprint in the region was almost invisible. But today, it's South America's largest trading partner. In Brazil alone, trade has exploded past $180 billion. More than double what the country does with the United States. Not long ago, China relied heavily on American farmers for its soybeans. Now, that supply chain runs straight through Brazil. It wasn't coincidence, it was strategy. Trade, however, is only the first layer of Beijing's long game. Since 2005, China has poured over $300 billion into Latin America through loans and investments. They're financing mega projects across the continent. From deep-water ports in Peru to lithium mines in Chile, even a massive space tracking facility in the far reaches of Argentina's Patagonia. With every deal signed, American influence erodes just a little bit more. In places like Mexico and Brazil, public opinion has shifted. Many now see U.S. involvement as a political burden, not a benefit. For over a century, Washington shaped the region with military power, economic pressure, and diplomacy that often came with strings attached. Beijing's method is the opposite. No troops, no coups, just money, infrastructure, and patience. If that sounds familiar, it's because we've seen this same playbook before, in Africa, where billions in Chinese investment have reshaped cities, built roads, and won hearts. Now that same strategy is being deployed right on America's doorstep. And yet, Washington's response has been surprisingly muted. While politicians in D.C. argue over domestic battles, China is quietly embedding itself into the fabric of Latin America's economy. Not just as a trading partner, but as a power rewriting the balance in the Western Hemisphere. When you look at the data, it's hard to ignore. A map of Chinese-controlled or operated ports across Latin America looks like a web. Red and orange dots spreading across coastlines and shipping routes. The pattern repeats across highways, railways, even electrical grids. To understand how disruptive this really is, we have to look back at what used to be normal. After the Cold War, American dominance in Latin America was unchallenged. One by one, governments were pressured into aligning with Washington's economic agenda. Sometimes willingly, sometimes not. Whether it was crop eradication programs or trade rules, the U.S. set the terms. In exchange for cooperation, nations were rewarded with access to IMF or World Bank loans. Lifelines during economic crises. But every dollar came with conditions. The so-called Washington Consensus was sold as reform, but to many it looked more like America rewriting the rules in its favor. And if persuasion didn't work, pressure followed. Sanctions, withheld aid, and in extreme cases, regime change. For decades it worked, until it didn't. In 2017, Venezuelan President Nicolás Maduro defied Washington's demand for new elections. In response, the Trump administration unleashed one of the harshest sanction campaigns in modern U.S. history. The expectation was clear. The Venezuelan economy would collapse, and with it, the government. But that didn't happen, because China stepped in. They bought Venezuelan oil, extended loans, and kept the regime afloat. For the first time in generations, a foreign power openly defied Washington in its own hemisphere. And won. 2 decades earlier, such a scenario would have been unthinkable. Back then, China's presence in Latin America was barely noticeable. But that changed in 2001, when Beijing joined the World Trade Organization. That single move opened the floodgates. Throughout the 2000s, China's economy grew at breakneck speed, averaging 10% growth year after year, doubling in size every 7. Factories in Shenzhen churned out electronics, clothes, and machinery that powered the world. But to sustain that growth, China needed something Latin America had plenty of. Resources. Iron, copper, oil, soybeans. The raw materials that fueled China's rise. In return, Latin American markets were flooded with affordable Chinese goods. It was a perfect match. China supplied the industry. Latin America supplied the materials. Between 2000 and 2024, trade between the two skyrocketed. From just $12 billion to over $500 billion. It might be tempting to think the U.S. simply missed the warning signs, but that's not entirely true. In many ways, Washington enabled China's rise, believing that economic integration would lead to political liberalization. The idea was that opening China's economy would eventually open its politics too, but that plan backfired. By the early 2010s, Xi Jinping was consolidating power, both at home and abroad, including right in America's traditional sphere of influence. It was only then that Washington realized the scale of its mistake. It hadn't just helped build China's economy. It had invited Beijing into its own backyard. Today, China is Latin America's largest trading partner, excluding Mexico. And it's not slowing down. The demand for raw materials has fueled a boom across South America. Millions of jobs created, tax revenues up, and exporters thriving. But there's a darker side to the story. That prosperity comes with dependence. In Chile, for instance, nearly 40% of exports now go straight to China. mostly copper. If Beijing ever decided to stop buying, the Chilean economy could collapse overnight. Mines would close, workers laid off, and the government left scrambling to fund basic services. This isn't just trade anymore, it's leverage, and China knows how to use it. Because trade was only step one. The real game is investment. Since 2000, Chinese state-owned enterprises have poured over $200 billion into Latin America's most strategic sectors: transport, energy, and raw materials. Unlike U.S. investments driven by private firms, this money serves a national strategy. In 2018, Beijing officially invited Latin America to join the Belt and Road Initiative, its grand plan to anchor the 21st century global economy around China. 2/3 of Latin American nations have now signed on. The results are everywhere. Solar farms across deserts, new ports along the coasts, railways slicing through mountains. And when governments ran out of money, Beijing opened the credit lines, lending over $140 billion, more than all the Western development banks combined. The message was clear. China doesn't just offer money. It offers freedom from Washington's financial system, and even from the US dollar itself. Some of these loans aren't paid back in dollars at all, but in Chinese yuan, or even barrels of oil. This isn't just an economic relationship anymore. It's the foundation of a new global order, one being built quietly, trade deal by trade deal, right in America's own neighborhood. China's footprint in Latin America has been one of the quiet revolutions of this century, and it's already outpacing anything Washington, in 3 presidencies, managed to secure in its own hemisphere. Beijing doesn't arrive as a tourist. It shows up with contracts, concrete, and ceremonial scissors, and it leaves with infrastructure and influence. In Peru, Chinese officials upgraded a trade pact and cut the ribbon on a massive port built by Chinese engineers. In Brazil, what began as trade diplomacy was elevated to a formal China-Brazil community, the highest diplomatic honor Beijing grants, signaling a relationship that now functions more like partnership than patronage. These were not isolated wins. China has moved from one-off bilateral deals to building multilateral platforms where the United States is noticeably absent. At the China-CELAC Forum in 2025, Beijing framed itself as Latin America's sibling in the global south, a public posture of solidarity against what it called Western economic coercion, and then backed the rhetoric with cash, pledging another $9 billion to regional initiatives. Step by step, Washington's missteps have become Beijing's openings, and the region is responding. Where more than half of CELAC's members once recognized Taiwan, today only 7 do. A stark metric of shifting loyalties, not a mere footnote in a policy paper. Why is China pouring so much time, money, and political bandwidth into a region thousands of miles from its shores? The answer is simple and existential: resources. A decade ago, Beijing's Latin American strategy was built around oil. Massive loans to Caracas that were repayable in barrels, not cash, guaranteeing China privileged access to Venezuela's reserves regardless of political turmoil. But energy was only the beginning. Since 2018, Chinese state firms have spent billions buying stakes in lithium projects across Argentina, Bolivia, and Chile, the heart of the so-called lithium triangle, and poured capital into copper mines from Peru to Chile. In some cases, state groups control sites that alone produce a perceptible percentage of global copper output. These raw materials are not commodities in the old sense. They are the raw DNA of tomorrow's economy. Lithium and copper power batteries, renewable grids, electric vehicles, data centers, and the chip factories central to AI and advanced manufacturing. Whoever secures these supplies early will dictate the rules of industry for decades. Beijing isn't speculating, it's securing a lifeline. China's growth model of cheap exports and low-cost labor is running up against the limits of labor costs, technological competition, and the middle-income trap. The window to move up the value chain, to dominate EVs, renewables, semiconductors, and AI, is narrow. If China locks in raw materials now, it doesn't simply join those industries. It positions itself to lead them. Miss the window, and entire sectors ossify under rival leadership the way Europe and the United States once consolidated automobile and aerospace dominance over generations. That urgency explains Beijing's scale and speed in Latin America. This is strategic insurance, not charity. For Latin America, China's engagement is double-edged. On one hand, Chinese investment can be transformative: roads, ports, mines, factories, and capital for governments starved of alternatives. On the other, it rewrites leverage. With China as a credible funder and market, regional leaders can bargain harder with Washington and the IMF, extracting better terms and fewer political conditions. That newfound room to maneuver is empowering, but it also invites risk. The Cold War's shadow is long. Past great power competition in the region fueled coups, covert operations, and pain. If the world is sliding toward another geopolitical standoff, Latin America risks becoming ground zero. not just a prize. For the United States, the stakes are existential, losing influence in its own backyard to a rival that controls critical inputs for the next industrial revolution creates strategic vulnerabilities that touch everything from energy security to defense procurement. As global powers jostle for resource control, one asset has reasserted its ancient role as a safe haven: gold. Prices have climbed into territory most analysts describe as unprecedented, surging above $4,000 an ounce and drawing comparisons to the 1970s era of elevated inflation and geopolitical turmoil. Billionaire investors and macro strategists point to familiar dynamics: currency pressure, debt, and the scramble for hard collateral that are buoying precious metals. In response, the Trump administration has moved to reshape U.S. resource policy and the domestic mining landscape, signaling a new federal priority on mineral independence. Executive orders have accelerated permitting and domestic exploration, and at the state level, Alaska has emerged as a focal point of ambition. Projects in the far north, including large undeveloped gold-copper deposits, are suddenly framed as national strategic assets, with infrastructure approvals and political visits underscoring their importance. Private companies are quick to highlight their positions in this changing market. Large resource estimates, concentrated insider ownership, and advancing preliminary economic studies become the language of opportunity when commodity prices spike and policy shifts favor domestic production. But the usual caveats apply. Resource estimates and early-stage assessments are not guarantees, and markets move on many signals, not least geopolitical risk and capital market sentiment. Do your own research, read technical filings, and treat investment theses with the scrutiny they deserve. In short, China's push into Latin America is a long game with immediate consequences. It is about securing the metals and energy that will fuel clean energy and high technology. It is about changing the balance of diplomatic influence in a region the United States once viewed as its unambiguous sphere. The result is a global contest over resources, alliances, and industrial destiny. And in that contest, commodities have become geopolitical power.